What makes a good company to invest in? This is a question that often boggles the mind, especially for those who are fresh on the path of their financial journey. The labyrinth of the stock market, with its myriad complexities and intricate details, can sometimes appear as a daunting and overwhelming challenge. Yet, the key to unlock its secrets and mysteries lies embedded in a deeper understanding and accurate interpretation of essential financial concepts and indicators. These provide a comprehensive 360-degree view of a company's financial health. By gaining a deeper insight and better command over these indicators, the formidable process of assessing a company's worthiness for investment becomes significantly less intimidating. Today, we are going to dive deep into the first and one of the most crucial financial indicators, the price-to-earnings ratio, commonly known as the P/E ratio. This notable financial benchmark serves as a tool to evaluate the correlation between a company's existing share price and its earnings per share, which is essentially its profit. To simplify the concept further, the P/E ratio primarily addresses this pivotal investment query. How much is an investor expected to shell out for every single dollar of the company's earnings? The P/E ratio serves as a barometer of market expectations and is capable of shedding light on a stock's potential value. A high P/E ratio may be suggestive of the market's optimistic outlook towards the company's future. This could imply that the price of the stock is significantly high when compared to its earnings, indicating that the stock could be overvalued. On the other hand, a low P/E ratio could signify that the market holds a more conservative or less hopeful view of the company's potential. It's important to underline that a low P/E ratio could be indicative of the market's tempered expectations for the company. This could potentially suggest that the stock is undervalued. If that's the case, it may represent a ripe investment opportunity. Other factors are favorable too. Therefore, understanding the P/E ratio along with other financial indicators plays a crucial role in making informed investment decisions. Conversely, a low P/E ratio might indicate that the stock is undervalued. Next, consider a company's earnings before interest, taxes, depreciation, and amortization, better recognized as EBITDA. This key financial figure provides a more precise evaluation of a company's financial well-being. EBITDA's purpose is to isolate earnings from the primary operations of the business. It does so by excluding factors such as taxes, interest, and amortization. With these items set aside, we can concentrate purely on the income from the business's core activities. The simplicity of EBITDA enables a clearer view of a company's real operative performance. It filters out possible distortions arising from variations in tax codes or capital structures. A consistently high EBITDA is generally seen as a company with robust profit potential. A return on equity, or ROE, is a metric of immense importance. This financial ratio has drawn much attention from investors and analysts worldwide due to its ability to reveal the efficiency of a company's operations. ROE is derived from a simple formula that divides a firm's net income by shareholders' equity, quantifying the amount of net income returned as a percentage of shareholders' equity. It serves as a pointer, a compass guiding investors through the complex world of corporate finance. This pivotal financial indicator goes beyond just stating numbers. It's a mirror that reflects a firm's financial acumen. It assesses the ability of a company to yield profits from the capital it has received from shareholders. RO enlightens investors about the degree of profit an entity can churn out using their funds. The ROE not only measures profitability, but also efficiency. It shows how adept a company is at deploying shareholder investments, giving a peek into the firm's ability to leverage its capital to expand its profit margins. The higher the ROE, the more proficient the company is at reinvesting its earnings to yield further profits. This crucial metric provides both current and potential investors with a transparent, comprehensive view of a company's financial prowess. It grants them the knowledge to make informed decisions, understanding the business's health and growth trajectory. Now we move to another significant metric, the debt-to-equity ratio. This ratio offers a different perspective into a company's financial health, indicating the proportion of a company's funding that comes from debt rather than equity. The balance between these two funding sources is critical. A high ratio may signify higher risk as it reveals that the firm has heavily relied on loans to fuel its growth, which could potentially strain its financial. Understanding a company's business model is a fundamental step in the investment analysis process. The importance of this understanding lies beneath its ability to reveal how businesses generate profits and whether this profitability is maintainable over time. This is what sets the foundation for discerning if a company's business model is not only profitable, but also sustainable in the long term. In order to assess this, it's necessary to identify the company's distinct competitive edge in its industry. Does it possess superior technology, customer service, or unique marketing strategies? Are they able to maintain and enhance this edge over time, allowing them to stay ahead of competition? But it's not just about the current state of the company. Considering the future is equally important. What do the future avenues look like? Is the company in a to overcome possible hurdles and exploit opportunities that may arise? The potential for future growth is an aspect that can't be ignored. It's essential to closely examine trends and future projections because a company may be flourishing at the moment, but could it sustain this in the future? Conducting comprehensive research of such trends and predictions is key to identify companies that have promising growth prospects. A keen understanding of both the present and the future can be the difference between a good and a great investment. After all, understanding the company's business model is a fundamental step, and researching trends and predictions can be instrumental in pinpointing companies with promising growth prospects. Now that we've covered the basics, it's time to delve deeper and scrutinize how these principles apply in the practical world. We'll explore some tangible instances from the dynamic stock market to enhance our understanding of how these metrics can shape your investing decisions. To initiate, let's consider a business entity showcasing a high price-to-earnings ratio, commonly known as the PE ratio. This could potentially suggest that investors are forecasting a high range of earnings growth in the imminent future when compared to the broader market. However, it's crucial to remember that a high PE can often signal overvaluation. Undertaking an exhaustive investigation of such a company can furnish a lucid picture of the forces driving its inflated PE ratio. Moving forward, let's examine that consistently exhibits a high EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This is suggestive of a robust operating performance, which is a favorable indication for potential investors. Nevertheless, it is also vital to take into consideration other contributing factors, such as the company's standing on the debt and its capital expenditure requisites. This comprehensive evaluation is necessary to fully grasp a company's financial health and potential for investment. Next, let's pivot our attention to a company with a high return on equity, abbreviated as ROE. This suggests that the company is efficient at reaping profits from every unit of shareholders' equity. But yet again, it's crucial to consider other elements, such as the company's financial leverage, to gain an all-round understanding of its financial well-being. Subsequently, we will delve into analyzing a company with a distinctive business model and competitive advantage. This could be a company that has managed to etch out a niche for itself in a fiercely competitive market, or one that has innovated a unique product or service that sets it distinctively apart from its challengers. In conclusion, let's evaluate a company demonstrating strong corporate governance. A company with a competent ethical management team, complemented with transparent corporate governance practices, is more likely to thrive in the long run, thereby it a potentially enticing investment option. By studying these examples in detail, you can better comprehend how to apply these theories when evaluating potential investments. Remember, investing is not just about selecting the right stocks. It's about understanding the underlying businesses. The more informed you are, the better your investment decisions will be. Voiceover. All right, now let's shift gears and examine some specific stocks that have outperformed people's expectations. This will help us understand how the principles we've discussed can be applied in real-world investing. Firstly, let's consider Stock A. This company's stock has significantly outperformed the market. What were the contributing factors? Well, a closer look at the company's financials reveals a high EBITDA and a strong ROE. This tells us that the company has been operating efficiently and generating substantial profits. Additionally, the company's innovative business model and strong competitive advantage have played a pivotal role in its success. Next, let's move on to Stock B. This stock has also seen impressive performance, which may have surprised some investors. The reasons behind this unexpected success? A low debt-to-equity ratio indicating a strong financial position, coupled with a robust business model that has enabled the company to thrive even in a competitive market. Moreover, the company's management team has demonstrated strong leadership and adherence to good corporate governance practices, contributing to its high performance. Finally, let's examine Stock C. This company has outperformed the market, driven by its high earnings growth, as indicated by its high PE ratio. However, it's not just the high earnings growth that has led to its success. The company has a unique product offering that sets it apart from its competitors, and its strong corporate governance has built investor confidence. These examples illustrate the importance of thorough research and a deep understanding of a company's financials and business model when investing. Remember, investing isn't just about following trends or gut feelings. It's about understanding the underlying business and its potential for growth. The more you know, the better your investment decisions will be. In our next segment, we'll delve deeper into how you can use this knowledge to build a strong investment portfolio.